like to welcome anybody, especially if you're a newcomer to the roundtable. I'm joined here by three of my best friends in the world: Ken Kabula, Cy Lynch, and Hugh McManus, and I'm Mark Robertson. And you can see that I've actually been under the weather the last couple of days, and I actually didn't do any vandalizing of our cover slide. And I arrived tonight to find Mr. Kabula in the act of it. And remember, he's the guy that said no costumes. He's actually stuck party hats on us with a couple of party favors, and we are celebrating the closure of 2010, a year which has been fairly good to many of us. And we just hope to learn from each other and prosper to the best of our abilities from the new year that will soon be 2011. Why don't you go ahead and flip me to the next slide, Ken. Here's our agenda, especially for those of you that are new. We'll just give some quick opening remarks, take a look at some results from the previous months. We've been doing this since July, meeting once a month to do this. I'll make some big picture comments about the year coming to a close and some of the things we're going to be looking at as not only a group of four of us, but widespread community of long-term investors. I'm going to propose that we challenge at least part of our STRA position, and then you'll see stock selection presentations by Cy, Hugh, and Ken on the companies shown there. And if we have any time left over, you know that we're pretty informal about this. We'll gladly welcome any questions and answers that people might have towards the end. Go ahead and flip it, Ken. Here's your reminder, that this is an educational moment. This is sponsored. Thank you to the Mid-Michigan chapter of NAIC Better Investing. And again, this is just a quick reminder that we are going to be talking about real stocks in real time. We could own some of these companies, but the case studies that we will be talking about are for educational or illustrative purposes only. No investment recommendation is intended. Go ahead, Ken. All right, just a quick reminder. As I said, we've been doing this, selecting stocks, building out a portfolio since July. We are attempting to build a successful portfolio that's predominantly what we might call core or blue chip, or however you want to think of them, holdings. But we will permit, and in fact encourage, under the right conditions, playful selections, or the non-core selections that you heard us talk about a little bit. And our goal is absolutely to achieve and maintain a long-term relative return of plus 5%. And again, that would be benchmarking versus the total stock market index, the Wilshire 5000. We want our selections as a group to collectively outperform the Wilshire 5000 by 5% over the 5 percentage points over the long term. Go ahead, Ken. All right, here's a quick look at our results so far, and let me kind of take a little more time with it this month. This is our roundtable scorecard. You can see every selection that the four of us have made over the last 5 months or so. You can see the ticker symbols are listed there. The accuracy rating column is simply whether or not that particular selection outperformed the total stock market, including dividends, since the time of selection. We do display the average cost, the price as of today. That may be last night's close. I'm not sure when I grabbed that. So you can see that as you scan down that total return column, it's really good. Quite comforting to see all those green numbers there. There's just a couple that have been a little bit sluggish. The market return, again, is the change in the Wilshire 5000 since the date of selection, when the companies were added to the portfolio. And again, the one that we're really focusing in on, especially as a larger group result, is the relative return for all the companies. And as you look down the list, you can see that, look at Walgreens, selected on August 20th, has outperformed the market by 19.7, and that one obviously helps quite a bit. Just last month, a few of us cringed when Hugh doubled down on Bank of America, but you can see that Bank of America over the last 2 months I heard a little laughter there, are among the best selections that we've had, since we began this. But again, the most important thing is, what does it all add up to? And starting first with the accuracy rating on the left, we really hope to see us get into that 70 to 80% range. In other words, 70 to 80% of our selections outperforming the market during the time that they're held. Just to give you a frame of reference or some context, we find when we look at the people participating in the the Motley Fool's caps contest that 40% is pretty average. It's pretty close to a median for the total universe of participants over there at the Motley Fool. The better stock pickers get up into the 70s, 80s, and 90s, and we would certainly like to be in that 70 to 80% range. You can see that our average total return for the stocks that we have selected is 12.7. Over that same time frame, the average market return is 11.9, so we basically have approximately a 1% advantage to the market. And as you kind of eyeball that right-hand column, our selections have behaved quite well over the last 2 to 3 months, and we're quite happy with that. Let's go ahead and go to the next slide. On this next slide, I think we need to go the other way. Thanks, Ken. You see one of our traditional dashboards. This is always available at Manifest Investing, where we've displayed some of the key investment characteristics.
Mark, could I interrupt for just a moment?
Sure.
While you were on that last slide, we're getting a question from Miriam. She really doesn't understand the concept of relative return. Could you go over that just a little bit more for her sake?
Absolutely. Thanks for the question, Miriam. Why don't we go back to the last slide, Ken? Or the previous slide. Thank you. Let's go ahead and go up to the very top, and we'll talk about Lilly, the very first stock at the top of the chart, Miriam. This will be good for everybody. You can see that at the time that we had our meeting back at the end of July, the cost of Lilly, it was one of Hughes' first selection, was $34.66. You see the $34.66. The price as of yesterday was $35.02. So the total return, and again, it's just the difference between the $34.66 and the $35.02 is 1%. Okay, over that same time frame, from July 30th until today, the market has actually gone up 15.5%. So what we're basically saying is that, it feels good to go up 1%, but keep in mind that the average stock has gone up 15.5%. So the relative return is just one minus the other. The total return of 1 minus 15.5 gives us a negative 14.5. Now, as you'll probably hear from both Cy and Hugh, and in fact all of us, that is nothing. That's absolutely nothing to panic over. We're long-term investors. In fact, we expect and hope, we cross our fingers, we expect that relative return will actually come back and behave itself over the longer term. So I don't know if that helps or not. Relative return, again, just the basic definition. It's a form of benchmarking where you're comparing your total return, actual result, versus the market over the same amount of time. So again, the one that we're most willing to talk about would be my selection of Walgreens back in August. And for those of you that attend the Challenge Club meetings, I don't do I told you so's, but I did nominate Walgreens for the Challenge Club back in August. Got voted into the ground, literally bloodied and battered into the ground by a huge margin. I'd just like everybody to notice that 38.6% return on Walgreens. I would never do I told you so though. Hopefully that helps, Miriam. Let's go ahead and go on.
It helps me, Mark. I always thought relative return had to do with how fast your mother-in-law came back.
That's certainly an appropriate comment for the holidays, Si. And I'll try to stay out of trouble with that one. Okay, and here's another way of keeping track and seeing how well you're doing with our dashboards. On our tracking dashboards, what we'll typically do, and we do it in this case, is at the time we make a selection, let's go down to the bottom for this one. Ken actually nominated Zhongping last month, ticker symbol HOGS. We invested $1,000 a month ago into HOGS, and you can see that the value today is sitting at $9.97. So it's basically been flat. We're down a couple dollars. But every single one of those positions, take a look at Walgreens. Again, purchased back in August, we put $1,000 into it. It is now $13.94. So again, this is a form of keeping score. Walgreens at $13.94 is up considerably. And you can see the rest of what we think are the most important investing characteristics for the portfolio. Now again, you guys all know this. We This one is ranked from top to bottom by size of position. The top 4 positions are repeat selections. So $2,000 would have been invested into Bank of America, BioReference Labs, and that's sweet there, Si, huh? The BioReference Labs finally went up and actually gained 5, almost 6% over the last month.
Yes.
And that's nice. And Abbott Labs, we're going to hear about Abbott Labs tonight. That one continues to be sluggish and continues to be one that attracts our attention based on the investment characteristics there on the right.
Mark, I have a question and a comment. Marty wants to know, where are you getting the market returns from? Is it being compared against an ETF or a mutual fund? Where are you getting the market returns from? And then another comment that the prices shown on this particular slide are 1 day old, and in fact, all of our stocks are green if we use tonight's closing.
Oh, thanks. Good comment. Yeah, they are 1 day old, so we're all in the black or the green as of now. To answer your question, Marty, we use the total stock market index fund for the most of the time. We're benchmarking against, and the ticker symbol is VTSMX. VTSMX, and you could use VTI, which is the same Wilshire 5000, only with VTI is the ETF, so you could also benchmark against that. So we do use that as the benchmark. VTSMX, the total stock market index. And again, that's still going to be fairly large cap weighted, but that's what we use.
And then, Mark, we have a hand up from, is it Michael Eng? Michael, you're unmuted. Go ahead.
I had just, everything had gone mute, and I was wondering why, and it's back online, so I'm okay. Thank you.
Good.
Okay, thank you.
Good to hear from you. All right, so this is the portfolio that we'll be working on tonight. You'll see that we're going to actually shop inside the portfolio for a couple of selections and go outside for another. So with that, we will go ahead and I'm going to go ahead and just have a few comments about the long-term perspective. And again, I wanted to place this in the context of where we're at, end of the year. We can be a little bit reflective. What you see here is you can see a link at the bottom of the page. It's a Morningstar.com market valuation. They compute fair values on all their stocks, and they compare price to fair value. That's what you're seeing here, price to fair value. So when something is overvalued, it would be, let's say that they thought the fair value of company A was 100, and the stock is at 110. It would be overvalued by 10%. It would show up here as 1.1. By the same token, if they think the fair value is 100 based on their analysis of the company, and it's trading at $90 a share, that would be 10% undervalued, or it would have a price to fair value ratio of 0.9. So this gives us some context of, what can be one of the bigger challenges facing long-term investors. I don't know about you, but back during that, in fact, Ken, you might want to circle it back towards late 2008. That was a time frame when, frankly, you just had to grit your teeth, and it was a gut-wrenching time for investors, as we just watched. If you focus in too much on price, stock prices, they were plummeting. Well, at the same time, the fundamentals were okay, and it was a time to do lots of shopping back in late 2008, early 2009. Some of you will recall we actually had a couple back up the truck moments around Thanksgiving 2008. And then early March 2009, as you can see in that circled area on the right. It's just the opposite of the time frame that Ken has circled there under overvalued. Late 2004 was a time to be careful, and our message to investors was stick to the bluest of the blue chips, the deepest of the deep blues, and it was we actually hinted that we were exploring that it might actually be okay to accumulate more cash. So again, this is a 10-year perspective. You can see how things move around a little bit. And again, our message is using the analysis techniques at Manifest Investing, within the Better Investing community, or even over at Morningstar. If you kind of can pay less attention to the stock prices, and for that matter PEs, and pay more attention to these type of measures, it tells you when to go shopping and when to kind of pull back a little bit. Right now, my personal theory on the right-hand side of this chart is we're headed towards the land of overvalued again. And in fact, I would not be the least bit surprised with all of the political exuberance and all the stuff that's going on. We do seem to see a recession in recovery, to see those numbers actually, our projected returns might plummet, and the price to fair values that are shown here at Morningstar could actually take off and approach those all-time highs that you see back there at the end of 2004. So again, under those conditions, what does that mean to us? This is what we're going to be exploring fairly carefully. We have been exploring it for months. Is it okay to accumulate a little bit of cash? Sell a stock and let the money sit in cash while you do shopping, whether that shopping takes a couple months, could take a few months to find a really suitable replacement candidate. So we're going to be watching those type of situations very carefully. And again, the message is, again, if you're going to be buying stocks, stick to the higher quality companies under those conditions, and that sort of stuff. All right, right here I'm going to just, since I don't get to present a stock tonight, I thought I'd present 12. Sounds fair enough, right? Here's our Christmas countdown 2010. I captured some of the images. For those of you that want to follow up on this, we actually presented an analysis, in some cases a bit of a case study, on the facebook.com/manifest investing page. We actually went through over a period of 12 days approaching Christmas Day and talked about each one of these companies, and you're going to hear about a couple of them tonight. These are all pretty good studies, some more than others. Those of you that frequent the Manifest forum, you can actually see what your colleagues and contemporaries think, because we actually put all of these to a buy, hold, or sell vote within the Manifest forum stocks folder. So again, many of the companies that are within the Roundtable tracking portfolio are listed right there on that list. And again, we just invite you to explore some of the stuff, especially if you're a fairly newcomer to our community, trying to figure out some of the nuances when it comes to the analysis of these companies. Go ahead and take a look, and if you have some questions, bring them back here or post them there on the Manifest forum. So again, facebook.com, Manifest Investing. You do not, and I need to repeat this, I know that there are a few out there that have absolutely no regard for Facebook. You don't have to be a Facebook member to use that page. If you're a user and you actually have a Facebook account, more power to you if that's what you like to do. We'd love it if you would like our page. And you know what that means if you're a Facebook user. And if you are a Facebook user, then we actually will be using that page, our Facebook page for Manifest Investing, to send event notices and just let you know what's going on and share some comments. For instance, today we posted some of the more attractive looking stocks from this week's edition of the Value Line Investment Survey. So again, just some ideas there, some places to look at some stocks, some good studies, and we'll move on to the next part of our program here. Just wanted to give a heads up or a shout out to our producer Dan Hornick, and you can see that Dan is in quite the festive mood here with his Bucky the Badger stuffed animal. I don't think Dan's going to the Rose Bowl, but he'll be there in spirit as the Wisconsin Badgers head west and experience the Rose Bowl. And yeah, I see the Packer thing, Ken. We're just letting that go, because for those of you that are on the planet Mars and haven't noticed, the Detroit Lions have won 3 games in a row, and that's all that matters right now.